Hello, good evening everyone. Today we are going to discuss one question which is related to the club and society Igcse. Okay, this is very simplest question, and in this question there is a financial year given to you for Hillcrest Athlete Club, and this is your opening. This is your opening year and this is your closing year. Means whatever the balance you are having for this year, it's your opening balance, and this is from this you can get your closing balance. Okay. So again, this side you get amount received, this side you get amount paid, and there are some information related to the equipment in this paragraph. Okay, so what you need to do, first of all, in A part they ask you to prepare income statement. So how you going to prepare the income statement? The first thing is, for preparing the income statement you need to know your sales. Okay, so how you going to calculate your sales? If it is given in your question, it's okay. If it is not, then let's see. Okay, so cafe sales is already given to you, that is 10,430. So we can write 10,430 here. Okay, and then from the sales, from the net sales, okay, we have to deduct our cost of sales. So cost of sales. Okay, so what is your cost of sales? Your opening stock, your purchases, and closing stock. Purchases at, opening stock at, and closing stock deduct. Okay, so purchase opening stock. Okay, opening stock of cafe inventory, that is your 790. So 790. Okay, and the closing stock is 850. So 850 here. Okay, now there is no purchase. They did not say anything related to the purchase, but they told you related to the cafe suppliers. The cafe suppliers. Okay, from the cafe supplier account you can find out your purchases. So how you going to prepare cafe supplier account? First you need to write down the balance brought down here, and balance carried down this side. So balance brought down means your opening value of cafe supplier, which is 1292. Okay, and your closing balance of cafe supplier is 1137. Okay, next, any amount if you paid to the cafe supplier, you have to record it here. Bank, that is your 7998. Okay, after adding these two value, you'll getting 9135 this side and 9135 this side, and then whatever the balancing figure you're having, it's your purchase, that is 7843. So you can write 7843 here. Okay, yes, and when you're going to deduct all these things, means whatever you are having, opening stock, purchases, less closing stock, your cost of sale is like 7783. Okay, so it's clearly visible, like you earned a profit from your cafe, that is 2647. Okay, so I think this is very much clear to you. So the new thing is, if there is no purchase, then you have to prepare your supplier account for that. Okay, now moving forward to the next part. In the B part they ask you to calculate the subscription account. Okay, so how you going to calculate the subscription account? It's up to you. You can make on the basis of the, you can make on the basis of on basis of like statement basis also, or it's up to you. You can use the T-shape account also. Okay, so how are you going to prepare? Okay, so subscription account, the trick is OPPO. Okay, so here again you have to write down the balance brought down, balance carried down this side. balance brought down this side, balance carried down this side. Okay, so subscription prepaid you have, subscription accrued you have. So for prepaid means P, the opening value is 1045. So the opening value is 1045. Okay, and there is no closing value, so dash. Then accrued means owing. So opening value of the owing is 760. So 760 here. Okay, because in brought down you need to write your opening value, and in carried down you need to write your closing value. Same goes with the prepaid also. Okay, I think this is a basic things. Okay, it's okay if you don't know. 780, and the closing value is 285, so we can write here 285. Okay, now what you have to do for that, okay, so just give me a moment. Okay, 280, right? 285. Okay, so 285. Okay, so now what you're going to do, whatever the subscription you receive, you have to record it this way, like bank account, and the subscription received is 16910. Now add these three value, 1045, 1045, and this 16910, 910, 285. Okay, whatever the total you have to write it in like this: 18240, 18240. From 18240 you need to deduct your 760, and whatever the balancing figure you're having, that is your 17480. So that's your income and expenditure balance. You're going to forward this amount into your income and expenditure account. Okay, so I think this is clear to you. Now in the third part, they asked you to prepare income and expenditure account. It's very simple. First you need to write your all income and then all expenditure. You have to deduct your expenditure from your income. So first thing, without having a single thought, first income from NPO is your subscription. Okay, and from where you got your subscription account, subscription value? From your subscription account. Okay, so from your subscription account, it is here the balancing figure. We get it from our account by recording all the opening and closing value, that is 17480. So we are going to record this value here as subscription 17480. Okay, any other income we are having? Yes, cafe's profit. So we have to write cafe's profit also, and from where we got that value, it is, we already calculated it here, profit 2648. Okay, so this we are going to use as a part of, because that's a part of our income. So we have to write 2647. Now the thing is, we get us from this point. Okay, during the year, the equipment was sold and replaced by the new equipment. So whatever the earlier equipment you're having, maybe it's because of the obsolete, or maybe it's damaged or old, you replace that equipment with the new one. Okay, and when you're going to sell it out, the net book value which you calculated for that equipment is 956. Okay, at the time the value is 956. Okay, so now how you going to calculate your profit? Okay, so how you going to calculate your profit? First of all, what is your equipment value, or what is the amount you get from the sales? So equipment value is 956, and you sold that equipment to that old equipment 1059. Okay, so the cost price, or you know, no, not cost price, it's your net book value. So net book value of the asset is 956. Okay, and there is a sales price which is 1059. So you get extra money. Whatever the extra money you're getting, that is your profit, and whatever the profit, that is your income. So 1059, if you're going to deduct 1059 from 956, you're getting a profit which is 103. Okay, so if you're getting a profit from sale of equipment, so you have to mention it as the income. If you're getting a loss, then you have to write it down in not in income side, in your expenditure side. Okay, so in expenditure, what else you have to record? Whatever the expenditure related to the NPO, whatever the expenditure is recurring nature, you have to record it in your expenditure account. Okay, so first thing is cafe supplier, no need to write. Then rent. Okay, so here in rent there is some adjustment. So rent, rates and insurance having value 4860. Okay, and there is the prepaid also, opening prepaid and the closing 155 and 180. Now listen to me very carefully. Okay, when you are having an expenditure, when you're having an expenditure, and in expenditure there is prepaid and the another thing is owing or accrued. Okay, so what you have to do, if it is prepaid opening balance and you're having a prepaid closing balance also, same thing in the case of owing, opening balance and closing balance. Okay, suppose suppose you're having an expense of 1000. Okay, and then you're having 2 years, 2010 and 2011, prepaid and owing. So prepaid is 100, owing is 500, closing is 500, then 500, then 200 and 300. Okay, so now what you're going to do, so in expense, that is your 1000, the opening balance of the prepaid, you have to add that, and the closing balance of the prepaid, you have to deduct that. Okay, so if it is in question, you're having 1000 and the closing value of the prepaid is 500, so 500 is going to be deducted from 1000, and opening value, that is 100, we are going to add it. Okay, now in the case of owing, the closing is going to be added and opening is going to be deducted. Okay, so what happened in this case, 1000, in 1000 200 is we are supposed to deduct and 300 we are going to add. Okay, by using this criteria, in this question you're having rent. Okay, in rent you're having a prepaid beginning value as well as prepaid ending value. Okay, so generally from expense we are going to deduct our prepaid, but which prepaid? The ending value. What about the opening? You are going to add it. Okay, so here opening value of rent, in rates and insurance, prepaid is 155, so 155 you have to add, and 180 you have to deduct it from your prepaid. Okay, then you'll get 4835 rent. Okay, And then what else you're having? New equipment, no need to write, because equipment we are not going to write as expenditure, we have to write the depreciation. Okay, so depreciation on equipment. So they told you equipment is depreciated by 15% per annum on the cost of equipment held at the end of each year. So at the end of each year, because they replace with the new one, and the new equipment you are having, that is 16,300. So what you need to do for calculating depreciation, 16,300 in times 15%, and you'll getting the depreciated amount, that is 2445. Okay, how you going getting this amount? By depreciation. Okay, by using this. And what else? General expenses. Then general expenses here, that is 14794. Now what you need to do, you just have to add this value, deduct this one because that's a depreciation and general expense, and then whatever you're having, if you're having a positive value, then it means you're getting a surplus. Okay, if you're having a negative value, it means there is a deficit, and in this case there is a deficit. Okay, so what is the amount, final amount of depreciation? That is 1844. Okay, so I think this concept is clear. Here we learn a new thing, that is this. It is not new exactly, because this is a common thing. In income statement you also did like this. In expenditure you add outstanding or owing, and you deduct prepaid. Okay, but that was your ending value at that time, that is your ending value. Okay, but what if you're having owing opening value, then you have to do reverse of that. It means you have to deduct that opening value. Okay, what if you're having a prepaid ending value, it means you have to deduct it. Closing value you have to deduct. But what if you're having a prepaid opening value, then you have to add it back. Okay, so this is the basic concept. So just learn this table. So how you going to learn this? Again I'm explaining. Expenditure, you're having two types of expenditure, not two types, maybe like prepaid you're having, and owing you having, or arrear or accrued. Opening value, if there is a opening value and closing value of the prepaid, then closing you need to deduct, opening value you have to add. And in case of owing, if you're having a opening value, then you have to deduct that, and if you're having a closing value, then you have to add it. Okay, so that's it for today. I hope you learn very well, and if there is any problem, please mention in a comment box. Everything is cleared by my side. Have a nice day.